it's very hard to get a grasp of what the fundamental rationale is for this rally that we've seen and the valuation of the markets at present. So what we're seeing is that the economic fundamentals are nowhere near as good as what the equity markets are pricing in. And the corporate fundamentals, which we saw in the US, which we're going to see coming through for August, are nowhere near as good as what the equity markets are pricing in. So really what we're seeing is a market purely driven by speculation and driven by excess liquidity in the system, which has been provided by the central banks and the government. So how the markets actually react, how institutional investors, fund managers, and the rest of the participants react to that excess liquidity is just unknown. So at the moment, we're just seeing markets on a runaway tear, which are creating as close to a bubble-like environment as we've seen since 2000.
How do you mitigate that danger then?
Look, Matt, it's really hard at the moment because as an institutional investor, you've still got to participate in the market and you've still got to be sort of riding that wave up. And certainly it's nice to see stocks come off their bottom, and it's certainly nice to see people make money. But what we're seeing is a lot of people come into the market, replacing term deposits with equities, speculating and day trading has seemed to have rocketed over the last sort of 2 months. So it's a very, I think, dangerous environment for a lot of people. For us as institutional managers, the only real thing that we can do is increase our cash holdings, look at some more defensive orientations, and have a diversified portfolio, which should be able to withstand any kind of downturn that we see.